Welcome to Asian Investors Network, where we help our community prosper and achieve their financial goals. Let's begin.
I'm not a financial advisor. I'm not licensed to give stock tips, and I'm not going to give any stock tips over here. But everything I share with you is a process of how I built my wealth and also what are some stocks that I look at. So just want to be sure that everything here is for education purpose only. So a quick introduction about myself. I've been a private investor for almost 10 years right now. And I'm based in Singapore, but I love to travel. So you can see that I went to the United States actually before COVID broke out. I think that was year 2020. I'm also founder of 10X Capital, which we organize the Asia's largest growth investing community. So formerly, my background was an investment analyst working in an investment fund, managing over 8 figures. So what I do is I publish a book. I really want to share my journey. What are my painful lessons? What are my struggles? So that investors like all of you or new investors don't have to make the mistakes. Previously, as an analyst, I was giving a lot of talks. Part of what I do as well, I guess, is to train newcomers, especially all these college students when they are looking at a thesis, investment thesis. I look at it. I try to refine it for them. I try to give my opinions as well. Other than that, I also talk about running a community. So this is what I do. I coach people. I guide people using my knowledge. I think investing, I just want to get maybe a comment, or how many of you think that investing is really difficult? Just type yes, or you can type no as well. Okay. So I'm gonna look at the response in the chat group right now. Okay, and I can tell you that it's really strange, because when I started out investing, it was so tough. There were so many things that I didn't know, and I thought that I'm bound to fail in what I do. But as gradually I got ahead, I realized that investing should be kept simple. And today I hope to really simplify some of the key concepts over here. Okay, so I do spend a lot of my time traveling to various states in the United States to meet managements, right? So you look at the bottom right. The guy is called Ian Castle. He's based in Philadelphia. He's one of the best microcap investor in United States as well. So really forming the networks. And I think investing is not just we ourselves, but really about forming great networks and learning how to win together. And that's why we are in the Asian Investors Network. All right. Okay. So why am I doing this webinar today? I think I've been really very blessed. Sam created such a wonderful community, and I think it's just really giving back. And I guess that I personally have went to a lot of webinars. And I feel very skeptical about it. Is this guy real? Is this guy having real substance or not, right? And you might be very skeptical about it. So I want to be completely transparent with you. I'm doing this because I want to, right? I'm already a full-time investor, and I like to give back, right? Other than that, there's no other personal agenda. To kind of show all of you a little bit about my results. So this was year 2020, right? Up 272%. This was year 2021, this year, up 97%. So I have various portfolios, and this year I've already made close to about 400K worth of profits. So at the end of the day, I'm not doing this to brag, but I'm just showing you that there's a way for all of you to profit in the stock market. It doesn't have to be very difficult, right? At the end of the day, I'm just very happy to pass on what I know to all of you. If it helps you to become a better investor, then I think it's good, right? And so remember, right? Whatever I share with all of you, I don't want all of you to take it full value. Consider whether this is suitable for you, because I would say that there's many roads to Rome, right? There's no matter that is always perfect. You must look at it and say, hey, is this something that's workable for me, right? But other than that, I'm just very happy to be sharing what I do over here. So I just want to talk about what's happening, right? So, around the world, COVID, how many of you think COVID-19 is over? Just type over. If you think it's not over, just type not over in the chat box, okay? I think it will be very curious to know what are the opinions of this group tonight. Okay, most of you say not, right? So I do believe that there's still a lot of uncertainty that's going around the world, the stock market. The stock market in itself is becoming more volatile, right? First, we have COVID-19, then we have Delta variant, then next we have a new variant called the Mu, right? And also now senior citizens are asked to take booster shots. I think President Biden is pushing that, right, to fight against COVID-19. So, when we thought that COVID-19 was within our control, things actually got worse, right? We have the fourth wave, we have the fifth wave, and we have so many things that's actually affecting our livelihoods and also affecting our earnings income. So what happens if we don't overcome this? What happens if we just stay where we are? That's the biggest question I always ask myself. What will happen if we stay where we are and we don't improve, right? I think we will continue to being stuck, right? Staying where you are right now, and maybe, because of COVID-19, because of external factors, how the economy is, right? It will actually affect how much you earn. But I would say that, in life, we always have choices, and the choices we make is really crucial. And I always felt that, I never wanted to rely on the economy to say, oh, maybe right now I'm going to make more money because the economy is doing well or whatsoever, right? I want to rely on my own skill sets. And I think investing is the one that actually have helped me to do that, helped me to got ahead of my peers at a very, very early age. So tonight, I hope to share a little bit about what I do. All right. So my thought process was very simple, right? There are different investments to grow your money. And I think some of you invest differently. And I think that's totally fine, right? There's cryptocurrency, there's property, short-term trading, algorithm, software, and even stocks as well, right? But I do say that, personally, this is my opinion. You don't have to take it, but is a perspective for you to consider, right? Cryptocurrency, I think, is still quite highly speculative. One moment is up, next moment is down. I wouldn't place 80% of my net worth on that, right? And if I can't do that, how am I able to grow my wealth confidently and also consistently, right? Is that something repeatable, and is that something scalable, right? Property, I think you really need to have very deep experience, right? I think there are some property investors here who have done very well, but I also known of investors who actually invest in their first property, putting a lot of money down, and if that property fails, that's a lot of issues over there, right? Because you have to take a lot of debt, and it's one shot, right, at a time. And if that doesn't do well, then you are going to be badly affected. So property, I think you really need someone that's capable, that's knowledgeable to do that. In terms of short-term trading, you need a lot of time. Always be in front of the computer, looking at complicated charts. Sometimes, unless you have all the time in the world, then sure, go ahead and do it. But the reality is that most of us don't. We have things to do, we have jobs, we have responsibilities, we have our family to take care, right? So unless you are a busy person, unless you are not a busy person, then trading is not something you want to do. As for algorithm software for trading, right, it really sounds sexy, but here's the truth. It actually forces you to trade, because what happens if you don't trade, right? Then you're not going to make money, right? And sometimes softwares could be expensive as well. So, just give you an analogy, right? It's just like swimming with a float, right? And the float is a software. And one day, if you don't have the float, you will drown, right? So, a lot of things actually, there are some things that you have to consider, right? Whereas for stocks, I do think that over the long run, I'm going to show you some statistics to prove that as well. There's really no drama behind stocks, right? It's straightforward. For stocks, you could get started with $200 or so, and you could have multiple shots. Maybe you could have a portfolio of 8 stocks, 10 stocks. And if one stock doesn't do well, and 2, 3, 4 other stocks does well, your portfolio overall still will be in a very good place. Okay. So I'm just going to run through very quickly what are stocks. I think some of you are very familiar with that, but just want to run through that. Essentially, let's say if you look at a company, right? A company has maybe 10,000 shares. And if you buy 100 shares of a company, it means you own 1% of the company. Very simple, right? Taking 100 divided by 10,000. So stocks are not just the tickers that you see in the stock market. Behind every stock is an underlying business, right? So can I get everyone to type in the chat box? An underlying business, right? It has real employees, real customers, and makes profits, right? So this is what I really believe in, right? Every stock, there's an underlying business. So some stocks that have actually done well in the past, you can look at Monster Beverage has done very well. Amazon, Mercado Libre, Zoom has done very well. All right. So I want to share with you a very simple story, right? Back then, I think, in Singapore, we call it secondary school, but I think in US, what comes before college? I think it's high school, right? So in high school, I think Alex, one of my friends, bought the first model of iPhone, and everyone was obsessed over the iPhone, and it was very evident that Apple had a strong brand and it could charge premium prices. But back then, as a high school student, I wasn't an investor, and I did not know that Apple is a listed company. But since then, I think all of us can see Apple have built a strong portfolio of products ranging from Apple Watch, iPhone, iMac, AirPods, and etc. And since then, you can see that Apple has done tremendously well from the time frame 2009 to 2021, up about 40 times. And that's incredible results. And I think it has made many ordinary investors millionaires, and they could actually live a comfortable life, right? And another example that I want to share with you is Netflix, right? If you have Netflix if you are a subscriber to Netflix, just type subscriber in the chat box. And if you could, let me know what is the latest show that you're hooked on, all right, on Netflix, okay? So you can look at Netflix in itself. If you look at the product in itself, right, you're paying just about $9 per month, but you get this whole range of shows, right? And in comparison, right, a movie ticket is probably like $6, $7, $8, right? And you can see that Netflix was a very valuable content entertainment solution for many consumers like all of us. And I also want to ask another question. If any one of us today decides to subscribe Netflix for a Netflix account, do you think Netflix has to spend any money to service you? Just type yes or type no in the chat box, okay? So Squid Game is good. I watched it yesterday. It was really, really good. That's why I slept a bit late, but it's worth staying up for, right? Okay, so the question comes again to Netflix. If they have to subscribe, if you subscribe to Netflix, right, does Netflix have to spend additional money to service you or spend additional money to deliver the content to you, right? Just type yes or type no in the chat box, okay? So I'll come back to that later on. But you can see something very, very, very amazing, right? Since 2009 to 2021, it has done incredibly well. And we call it a 100 bagger. It has actually returned investors 100 times its money, right? So I want to talk about, yes, incremental server bandwidth, nothing really, right? So the server costs are actually very cheap, right? Computing cost, server cost is very cheap. So you can see for Netflix, how scalable the business are. So, when you look for stocks that will do well, you got to invest in technology companies because they are highly scalable. I'll talk about that later on as well. So you might be wondering, okay, Kelvin, there are so many stocks in the stock market. Can all companies make money in the future? We will not know, right? Because what this question is focusing on is something dealing with the future, right? We don't have a crystal ball, and how can we predict which are the companies that will do very well? We can't. But what I can tell you is that I'll share you some criteria that I have personally chosen for myself, and they have helped me to tilt the probability of predicting whether this company is going to do very well or not. Okay, so this is going to be a game, and I need all of you to participate with me. So the first criteria that I look at is growing revenues. Okay, and I'll share with you what exactly I mean by that. Okay, maybe just very simple, right? How many of you have watched the Netball World Cup in 2015? Just type yes or type no in the chat box. And I'm predicting that most of you would type no. Okay. The truth is that I've not watched it as well. Okay, but I just want to be a bit curious about everyone. Okay, so if you do not know netball, I think this will be a very good example. It has always been New Zealand competing with Australia. So I want all of you to guess as well, right? Which country do you think won the netball World Cup in 2015? Just type in the chat box. Is it New Zealand or is it Australia? All right. I think I'll be very, very interested to see the comments. All right, type your guess in the chat box. Okay, Australia, New Zealand. So I think we have one New Zealand fan and two Australia fans. Okay, how about the rest of you? Okay, so I'll just move ahead first. So now I'll show you the facts, right? Since 1963 until now, these are the winners of the Netball World Cup. So now with facts, let's see if our opinion previously is correct. So you can see that most of the time, Australia have won, then New Zealand, Australia, then after that, Australia, New Zealand, and all the way Australia, right? In 2011, 2007, 2003, 2007, 2011, they are all Australia. So when it comes to 2015, right? Make a guess who actually won the World Cup, Netball World Cup. Just type in the chat box. Is it New Zealand or is it Australia? Just type in the chat box. So with a bit of information I'm passing to all of you, what is your take on that? Okay, very excited. Come on, type in the chat box. Let me see what are your guesses. So, wow, Sam is changing. Okay, Sam is probability, right? Okay, we have Australia one, New Zealand, then we have Australia as well, because past performance is no guarantee of future results. All right, cool. So, well, I want to review the answer to all of you. Well, actually, 2015, Australia have actually won I saw some answers, but I thought all of you don't watch netball. How come all of you know it's Australia? Well, here's the key takeaway from this example. It is just like companies, right? If companies have a strong track record of earning more money every single year, right, the tendency is that they are likely to continue. Of course, I do agree with Sam, like the past performance is no guarantee of future results, but the past do give you a very strong indication on how a business would perform moving forward. It's just like when you look at Netflix, they've been having this winning momentum, have been growing their business tremendously. Would the growth fall off the cliff overnight? The answer is no. So if you look at this company called Amazon and Costco, right? Which company do you think grew faster? Just type in the chat box, Amazon or Costco for me. Okay. You can see that in 2014, Amazon started off a very low base and it grew tremendously, whereas Costco have actually somewhat started from quite a matured base, but it still continued growth, right? So the answer is actually Amazon. And it's no wonder why, if you look at the share price performance, Amazon have actually outperformed Costco by a wide margin, right? Amazon is actually growing at have grown by 343% in the last 5 years, whereas Costco have grown by 200%. So the first criteria that I want all of you to remember tonight is that whatever company that you buy, do ensure that the revenue is actually growing more than 30%. Why is that so? Because stocks follow earnings, right? So most people in the stock market, they're just looking at share prices, and they're trying to predict the movement, right? But all these things are really as good as tossing a coin. But you really want to know what moves the stock price, then you have to focus on the revenue, right? See, good investors, they always look at companies and where the earnings are headed, and they do not need to guess where the stock price actions are. Instead, what they will do is that they focus on facts. So I do want to provide all of you with another example to really solidify this key concept over here. So this is an example that I need all of you to participate as well. So I have several companies over here. Johnson & Johnson have grown the revenue by 27.1%, AT&T 7.6%, Liet, which sells a protective extreme sports gear, grown by 71%. Then we have C, which is a emerging dominant e-commerce player in Southeast Asia, listed in New York Times, grown by 158.6%. So which stock do you think is something that you consider, and which stock would you not consider? Just type in the chat box. All right. Let's say just on a quick look. All right. You see, because every day we are all bombarded by a lot of stock ideas that's given by our friends. But it's so important that we ourselves have a framework, at least a very simple framework, for us to identify and differentiate which are the companies that we should be spending more time on and which companies we should not be spending more time on. Okay, so just type in the chat box. Which company would you likely to focus on? Just type in the chat box. All right. So Amy says C. All right. Okay. Now let's move on. Right. So you can see that I would say AT&T is not something I will look at. Johnson & Johnson is not something I'll look at as well. So, I think as investors, we need to understand one thing. We are in a very privileged position because we can invest in any company that's listed in the stock market anywhere in the world. So if we are investing in companies that are not growing, we are shortchanging ourselves in the process. And that's not a good way to grow your money, right? So I always want all of you to have high expectations of the companies that you're investing in. Because why? When you have high expectations, that means the number of companies that could meet your criteria, it will be narrow. It will be lesser, right? With lesser companies to look at, actually you will outperform. So one thing that a lot of investors like to do is to look at every company, right? It's just like dating. You can't be dating all the girls. You need to know what kind of girls you like. You need to know what kind of guys you like, right? So I would remind all of you, right? Always have very high benchmark for the companies that you are investing in. So you look at AT&T, despite the big boom that happened in last year, 2 years, I think there's a lot of monetary printing by the Federal Reserve. But look at the 5 years performance of AT&T, right? Has gone up by 33%. Yes, right? So on a scale to 0 to 5, how would you rate AT&T performance? Just type in the chat box. Okay, I also see someone had mentioned Amazon as well. Okay, so from a scale of 0 to 5, how would you rate AT&T? Okay, -0. Okay, all right, so that's good. Now let's move on. So this is C in itself. 5 years performance have gone up by 21 times. All right, So I can share with you, while it is true that I might be oversimplifying investing, but how many of you can see that just by looking at the revenue growth rate, it allows you to choose better companies already? Just very simple. Just type yes in the chat box. Okay, and I want to share with you something, right? The funny thing is that we spend a lot of time thinking about what to eat every weekend, but we don't spend a lot of time, choosing good companies for our portfolio. So looking at the revenue growth rate takes less than 10 minutes, and it will change your investing results greatly. All right. So you can see that if a company is growing quickly, over time the business will become more valuable. As the business becomes more valuable, inevitably the share price would follow the trend as well. Whereas if a business is not growing, whereas a business is suffering, the price has only one direction, which is going down. So the second criteria that I want to share with all of you tonight is independent thinking. You might be thinking, is investing risky? What if other things that happen? What if some things that happen and they're not within my control, right? For example, COVID-19, a recession. What if a war happens? What if another pandemic happens, right? So a lot of us tend to have a lot of questions, right? And we think that investing is actually very risky. But I want to point this to all of you. So S&P 500, I think some of you are very familiar with it. Essentially, it means these are the top 500 listed companies in the United States. So when you're buying this thing called S&P 500, the index, you're buying a portion of every 500 companies. If you look at it very clearly, since 2009 to all the way to 2019, it has been almost 10 years, right? I could even draw this further back to like 1960s, 1980s, right? But we have went through the Iran war, government shutdown, multiple recession, bank crisis, slow growth, and many others, right? Government shutdown, Federal Reserve. I think last night talked about wanting to raise the interest rate. But if anything, this shows you that the long-term investors have thrived in the past, have done very well in the past, and they will continue to do so, right? The market has been going up despite multiple recession. Even if there's a war or not, even there's a COVID or not, business will still exist no matter what, right? So I think, a lot of us, I think economics are really important. I'm a student of the economics, but after investing for 10 years, I think what's more important is that, I am never really bothered about what the market is doing. What's the key thing here, right? The key thing is I'm focusing on the business that I'm investing in, whether they are growing or whether they are not growing. But if we are letting our fear of the stock market preventing us from becoming an investor, then I wish to share with all of you something. In every crisis, ordinary employees are being hurt the most because they lose their jobs, they don't have job certainties, whereas strong companies continue to thrive, right? Which means, right, if you are not a shareholder of a strong company today, you're actually missing out on a lot of opportunities. So I would urge all of you to look back. During COVID-19, it was one of the worst pandemic that we have suffered in the recent times. But look at the wealth of Jeff Bezos, look at the wealth of Elon Musk, look at the wealth of Mark Zuckerberg. They've all went up, right? Because the stock prices have actually all went up. So today, our job is to not just be an employee, not just be a business owner, but invest in other superior businesses as well. Otherwise, we are seriously missing out on a lot of wealth creation opportunities. Same thing here. You can look at 2020, March. Despite all these small hiccups, the stock market continued to move along. And I would say you are missing out on a lot of opportunities if you choose to be fearful. So yes, a recession will come, bad things will happen. But if you remain vested, if you have a long-term horizon, these things, they don't affect you in the long term, right? If you zone out, these are small hiccups. These are what I call a small blips, right? But the key thing is whether you are choosing good companies. I always believe Intel founder actually said something, right? Bad companies are destroyed by crisis. Good companies survive it. The best companies, they thrive during the crisis. Okay. So I'm going to play with a game with all of you, and I need all of you to participate as well. So let's say in this scenario, right? Kelvin, that's me, right? I'm driving a car, and I would like to reach from point A to point B. And the distance is 300 kilometers, right? But for me, I'm a bit different. I want to wait for the perfect weather to drive, right? So I say, if this is going to rain, I'm not going to drive. If there's traffic light on the roads, I'm not going to drive, right? And I'm just going to wait for the perfect conditions for me to drive. In scenario B, we have Sam, who is driving another car, right? Maybe even though the car, the model is a bit weaker in terms of horsepower, but Sam understands one thing. He understands that, okay, there's going to be rain, there's going to be speed bumps, there's going to be potholes. His car may even break down at some point of time. But Sam doesn't care about the perfect weather, and Sam starts his engine and starts moving right away. So now, who do you think will reach to their destination earlier? Just type Sam or just type Kelvin for me in the chat box. Okay, I think it'll be really interesting to see what are some thoughts from the audience tonight. Okay, so Sam, you have one supporter. Oh, you have two supporters. Okay, who else? Okay, no one is supporting me. Come on, guys. No one is supporting me. Oh man, I'm so sad. Okay, so I see 3 votes for Sam. Okay, so exactly everyone. So I feel that for investors out there, they're always so obsessed over the news, over the media every day. They're essentially waiting for the perfect stock market environment. The truth is that I want to break this bubble that all of you have, or some of you have. This perfect market environment, it doesn't exist. So, but we are while you're waiting every day, you are losing out on many good opportunities. So, I want to say something that goes against whatever I've been taught in school, but it stands very important for me as an investor. Why don't all of you ignore the market, ignore the media, instead focus on buying good companies that's growing at 30% or more and being very long-term in your approach? And this is what exactly top investors are doing. They're always focusing on their businesses, right? They're looking at Apple, they're looking at Amazon, looking at Netflix and asking themselves this question: do they have a competitive advantage? How is the business doing? Are their business still growing? Right. So, the key thing is that focus on the business, whether they're growing, instead of being so obsessed over the news. I know of investors who just glued themselves to Bloomberg, and every day they just trade in and out, and they can't seem to make any money despite making more efforts, right? Whereas I also see, on the other hand, investors who have done nothing much but look at good companies and held them for a long term, they actually made more money. So see, at the end of the day, if the business is growing, the stock market crash or not, it will come and go, right? But sooner or later, the share price will recover and reflect the true intrinsic value of the company. So now I also want to share with you, be suspicious of the media. Whenever you look at headlines, right, some headlines are meant to evoke fear. Why? Because it draws attention, it draws eyeballs. And why eyeballs, attention are important for them? Because essentially a lot of news media, their business model is run on the advertisements model, right? They want to attract viewers, and viewers might click on ads and they'll make more money. But when you look at research that's being done, they mention that financial analysts are utterly clueless. That's by Oxford University. This one is also saying that Wall Street analysts are embarrassingly bad at predicting the future. The economy says that the accuracy of equity research is consistently wrong. All right, so I want all of you to really think twice whenever you are just basing your investment decision on the media. But the key thing that all of us would really need, right? And I can say that all of us really have what it takes to be a good investor. You just need to use something that's in between our ears, which is our brain, which is our independent thinking, right? Really kind of believing ourselves, using a framework and really learn the right way. Because I've seen a lot of traders that trade in and out. And frankly speaking, I'm happy for them. They like what they are doing. But if they're not producing results, then, you may want to consider, some people are looking at stock market as a place to gamble, a place to have entertainment. But for me, I look at the stock market as a place that I want to make serious money that could really make me wealth, so that I could do some things for people around me. That's really the key thing. So the first thing that we have talked about is the growing revenue at least 30%. But second criteria that I do want to share with all of you is called a net debt to equity of below 50%. So this could be a new financial ratio for all of you, but this have helped me a lot in my earlier journey. So what does it mean, right? So let's say that if I'm an individual and my net worth is $100, right? And basing on this criteria, net debt to equity of below 50%, it means the maximum amount of loans that I can borrow is $50. And if I'm borrowing more than that, 60, 70, 80%, this means that I'm actually over leveraging personally, right? When we look at a business, it's the same thing. They have a balance sheet, they have the equity, so we don't want them to over leverage themselves, okay? Now, Facebook net debt to equity 0%. Why? Because they have too much cash on their balance sheet and they're still growing rapidly. Visa net debt to equity of 5.1%. AT&T net debt to equity of 128.8%. So just by looking at this, which company would fail your criteria? Just type in the chat box. All right. So while it's true that I'm oversimplifying things, but I can tell you this is what it really works. Investing doesn't have to be complex. Investing can be simple. And investing can be simple and profitable as well. Okay, so just by looking at this, you can see that very clearly AT&T is actually not doing well, right? It had too much debt, and that was the reason why the share price have actually collapsed. In Singapore, somewhere closer to my home, there's this company called Hyflux. It's actually a water treatment company. If you look at the net debt to equity, it's crazy. Straight off, I wouldn't buy this company. The local brokerages in Singapore was talking about the stock. They was saying that the intrinsic value is about $1.17. Then after subsequently they revise it downwards. They say that the intrinsic value is worth 59 cents, right? But just by looking at the net debt to equity in itself, I think it was very clear that in 2013, things were already quite bad, and we knew that eventually things were going to go really, really bad. So in Singapore, CAD, MAS are all regulatory bodies. They came in and the business went bust, and there was actually an investigation on how the directors were conducting their business. So a lot of times when you look at business, I think if you can take care of a few things, number one, they don't have too much debt. That means no matter what, crisis or not, they can survive. Even if their sales do drop, they can survive. Second, you have a growing revenue because you want a business to be growing. If they're not growing, then there's never a reason for you to invest in it. Your precious, your money is hard-earned. Your money is precious. We would only want to allocate it to the best companies that we can find in the stock market, right? If you agree with me, you can type agree in the chat box. So I do want to really emphasize that, market corrections are just small blips in the grand scheme of history. I want all of you to develop patience in what you do and understand why you're holding on to some companies. Because if you're buying a company just because your friend says so, right? If the stock price drop like 5%, 10%, you're going to be worried. You're going to be anxious, right? You're going to have a lot of emotional roller coaster. You don't know why you're buying the company, right? So, in everything, don't rush into it. It's not about like tonight or tomorrow, I'm just going to go in the market and buy 10 companies, 20 companies. No, take your time, right? Choose the companies that you want. You're like building a soccer team. You want the best players, right? You don't want to have too many players, but you want to have good players, right? Ultimately, I want all of you to think independently and ignore the market noise as well. So the third thing that I want to emphasize to all of you is that at the end of the day, companies are nothing without people. And people is, I would say, the soul, the energy of the company. So choose good, great management. So I do have some faces over here. If some of you could recognize the faces, their names, type in the chat box for me. All right. Now I'll know how many of you are more familiar with which CEO. So from my perspective, as investor, we thought that we are investing in companies, but the truth is that we are investing in people, right? A leader is always out there assembling an army of people, right? And when we look at a management team, we always want to ask, what is his purpose behind starting a company? How does he manage his team? And why are people attracted to him, right? And why would this CEO be successful when he's competing with so many other players? So to my point, I want to share with you a biggest discovery that I had over the last 10 years. CEOs that start business to make a difference, they tend to do very well. But CEOs that start a business to just make money, they tend not to do well because after they make money, they lose the steam, they lose the passion. So ironically, right, the companies with the biggest market cap are the ones who actually solve the biggest problems in this world. Think about Apple, right? Nokia, last time we were using plastic keyboards, but iPhone was the one who created a touchscreen, which added so much convenience and have upgraded the experience of using a mobile phone. So a lot of times when I choose to buy companies, I choose companies that are transforming the way we think, the way we shop, the way we sleep, the way we exercise. How many of you have a Peloton at home? Just type yes in the chat box as well. You see, Netflix have kind of changed the way we consume content, right? We may never want to go movies anymore. Maybe you just stay home for streaming purposes. iPhone, look at Tesla as well, right? So transformative companies, they tend to give a lot of upsides to investors if you can identify them very early on. So I think the question that all of us may have is this: how do you tell whether someone or a CEO is going to lead a company well? I think it starts with identifying who are some successful CEOs out there and what are the unique characteristics or qualities that they have. So one of the CEO that I really like to look at is this guy called Forrest Lee. He runs one of the dominant e-commerce player in Southeast Asia. So when I talk about opportunistic, right, they must be able to sniff out growth opportunities. They must be able to move very quickly when they see a opportunity. So back then in COVID-19, I think a lot of us were staying at home. We couldn't go out. as an e-commerce, I think Forrest saw that he has a very strong role to play to accelerate adoption of e-commerce for the consumers, right? He actually stayed in the office for 7 days a week, right, leading his company. And he also knew that more people would be playing games, which is why he was pushing his team to develop more content so that they can win more market share, where other players, they were frozen by COVID-19. They were not sure what to do and they freeze up, right? So they gave up a lot of opportunities. Second, visionary. I like Steve Jobs a lot. His famous Stanford speech. I think some of you have heard about the speech as well. So I think visionary ties back to what I mentioned earlier, right? I like to buy companies that are creating a step up in our experiences, right? Willing to envision a better future, a different way of doing things. Second, I think customer centric. Talk about Eric Yuan, who actually started Zoom, right? It's a much better experience compared to Google Hangout and Microsoft Teams. I think some of you use Microsoft Teams, but personally, I think Zoom is a much better experience. And I think Zoom is a software company that actually listens to customers really, really carefully. So other than that, I think it's being a lifelong learner, having understanding people as well. So how do I know about all this? I think it's very simple. It's very simple. You go YouTube, you search about their names. There's a lot of articles about how they think about the future. And I don't want a CEO that always think about the past. I want a CEO that's always very forward-looking, that's very aggressive, that's very ambitious, right? I think that's always the key thing. Otherwise, I don't believe, if a CEO is lazy, is incompetent, the share price will just grow just by itself, all right? So this Amazon, I would say that he has done tremendously well since 2009, 2010. That was the period where I started investing. So those early employees who work in Amazon, or shareholders who have identified exceptional talent in Jeff Bezos, and they stayed vested throughout. And I think many of them have become millionaires. And because of Amazon's share price, they could pay off their kids' college, they could buy a new house. So it pays very well to identify talents. And I think a big part of investing, a lot of people are just focusing on the financials, the ratios. Yes, I think we can be very obsessed with those numbers. But at the end of the day, if you cannot understand people, I think you are at a serious disadvantage. So I have transformed the way how I invest today. I think back then I was thinking of I'm investing in companies, but today I'm investing in people, right? But of course, it's not just investing in people, just listening what they have to say, but I look at numbers. So I kind of give a 50-50. You have the quantitative and you have the qualitative approach as well. So I think in summary, you're going to buy in companies with at least 30% in revenue growth rate, develop patient, understand their market corrections. This is a normal process in the stock market, and buy into exceptional leaders. They build wealth for their shareholders. Now, so you have high growth, you have independent mindset, and your management. I do think you have at least some outperformers that you can achieve for yourself. All right. So I do want to share with you that apart from tonight's webinar, is it okay if I just share very gently about how I can maybe value add to all of you so that you can learn more about stocks and execute out there in the stock market confidently, right? So what I'm going to do right now is share with you a little bit about what I have, right? So I have this course called a Growth Investing Mastery 2.0, Profit from Superstocks. So I took 10 years of my investing experience, right, coming from money, spending from books, courses, overseas trips, meeting managements, and speaking to fund managers. And the reason is very simple. Remember how we said that learning investing by ourselves was frustrating? I think we tried many things, and sometimes it was very painful to go through many things, right? And we would never want you to experience the painful lesson. So we believe, personally myself, I believe in providing a better experience to all of you. So this is why this course exists, right? It's an online course that can help you to find and invest in the next Amazon. So some of the takeaways from our people. This is Joycelyn Ong. So these are some comments that we have. This is Yong An, that's based in Singapore. This is Max, right? Giving us some comments. We have Beyond. Used to think about investing courses as a cost, right? Very skeptical person, but took a leap of faith and mentioned that this is the best investment I made in 2019, hands down. This is Yong Leong. Talk about his experience attending many investing courses, but this is hands down the best course he has ever attended. This is Wilfred, who's a property agent. Also decided to learn about investing as well. So what we're going to cover here is the quantitative. We talk about the financial ratios. I'm not here to train all of you to be accountants, so be rest assured that I'm going to teach all of you how to look at financial ratios from an investor point of view. Second, we talk about qualitative, the business, how to identify superior businesses, how to identify business risks, and I think most importantly, identifying the right entry price, because that's going to help you to make more money and minimize the losses in the stock market. And finally, finding world-class management teams, and also helping you to find out how you can sieve out the key information when you're watching an interview with CEOs, and giving you a lot of practical case studies, right? A lot of examples of companies that we have made money on, and some existing case studies that we think that is going to do really well. So these are all recorded in high definition on Teachable, right? So end goal here is to understand how to build a robust portfolio of super stocks, understand how to identify super stocks and how to analyze them, and finally, you don't value them in order to find the right entry price. So what you're going to get here is the online course, and second, the growth profit calculator. So that's an Excel file where you can key in several details, numbers, and we're going to guide you through the process so you can find the intrinsic value, the fair value of the company. And third, right, super stocks watch list. So as part of my experience as an analyst in the fund management industry, I've have a specialist of companies that I've collected over the last 3-4 years. So this list of companies is about 76 companies, and in those companies in the list, those are companies which I think potentially that's going to do really, really well. So that's the list that I'm going to provide to all of you. We have a Facebook group as well, something similar to Asian Investor Group, and also a 2-day live class, right? Because after attending the online course, you might have questions. You want to ask to dig a bit deeper. You want us to talk about portfolio management. The 2 days live class is there to make it happen. So I'm going to share with you this lady. Her name is Kim. She works in the semiconductor industry, works for AMD, right? So she has spent over 20K on 5 different courses, right? Investment courses, and caused her to lose significant fortune. But ever since she joined us in 2018, she made about 30%. So she bought this company called Hype International that's based in Singapore, and then Hypebeast, which is based in Hong Kong. In 2019, made about 20%, bought Himalcare. 2020 made more than 100%, investing in C Limited, CrowdStrike, which is a cybersecurity company that's based in Singapore, based in the United States. Power Technology, which is a software company that's based in the United States as well. So our portfolio has grown at more than $1 million this year. So this was posted in 2020. This guy Henry came from Malaysia. So he was actually investing in Malaysia companies all the time, and barely made any money right after 3 years. So 3 years is usually a long time, and when you don't make money, you're missing out a lot of growth opportunities. So decided to join the community, which is the course, because we are focusing a lot on US companies. And since then, his portfolio has been growing more than 20%. All right, so this is Gladys as well. Same thing, have moved away from Singapore investing, have moved away from investing on those big common names like blue chips like AT&T, Johnson & Johnson. Instead, she focused on companies that could make her real wealth, which is smaller companies or mid-sized company that was growing really, really well. Okay. So apart from that, I do want to share with you some profits that the gym community has made. So this is Ramlan. I think cover back the cost fees. Terrence up about 40% since he have joined. Jia Chen, right, up about 84%. Daryl, which is a Singapore actress, have covered back her cost fees. Janet as well is a student. Lillian, Yun Bing, Marcus, and many more, right? So we are actually over here wanting to impact more lives and really just hoping to draw people who are like-minded, who are growth-minded, who have this strong desire to grow. And we are not here for speculative trades. We are here to really learn how to analyze companies carefully. So everything that we do has a process, as a framework. So unless you are willing to put the work, you're not going to make money overnight. All right, just want to let all of you to know that. Okay, so these people are just tip of the iceberg in terms of our community members. Just want to share with you that this course and everything that you see is available at $610 US dollars. But currently we are not opening our classes, which means you are unable to register for the class, because a big part of our job here is to analyze companies, to run a fund as well. But we do want to value add to everyone. So we conduct this course once every quarter. So we do have a wait list for you to consider. So you can go to www.growthinvestingmastery.com, or you can take out a camera. You can actually scan a QR code to actually find out more about this. So if the course is available to you, once we open up the registration, you can actually register. So the course is not going to be a big one. It's going to be quite something that about 100 and 200. So we always have been trying to, reduce the number of people in the class, but the demand is quite strong. So it's about 100 to 200 people each time we run it. All right. So just let all of you know that this is something that all of you can consider if you want to. Other than that, before we take some Q&As from all of you, I just want to share that, if you want to have more investing resources, you can follow me on Instagram or even Telegram. We have a group called the Growth Investors. So with that, thanks so much, everyone. And maybe we can open up some time for Q&A. If you have some stocks that you're looking at, you can let me know. Maybe I can share with you some of my takeaways. But this is not financial advice. I'm just sharing about what I know. And maybe you have some other questions. I'm just happy to answer them. All right. So I'll pass back the time to Sam to maybe kickstart the Q&A.
Sure, thank you, Kelvin. So at this time, if you have any questions at all about investing in growth companies, this would be a great time to ask. What is lemonade?
All right. So Anthony,
Y'all don't know lemonade?
I know the lemonade. Yeah.
You don't know lemonade?
It's not the drink. It's a fintech insurance company, right, Anthony?
Yeah.
Are you vested in lemonade right now?
Was looking into it. I believe Chicken Genius was talking about it. So I'm starting to look into it.
Yeah, so Chicken Genius is based in Singapore. He's a friend of mine. He's going to tour Europe very, very soon. I think some of you must have watched his latest video as well. So Lemonade is a fintech company that has been, I think, growing relatively quite well, and it is very popular among the millennials. So it's no wonder, Anthony actually knows about Lemonade. So buying insurance is always a process where you have high premiums and you don't know if you're getting the best value. So Lemonade is not a price comparison website, but in fact they sell insurance to you, and you can buy it automatically through your phone. And if you want to do a claim, the claim process is a lot easier. So in short, what I can tell you is that Lemonade is an insurance company that is delivering a better experiences. That's very catered to very people who are very familiar, very comfortable using mobile phones to submit their claims, to buy insurance. What I can tell you is that Lemonade, in terms of the claims process, I feel like they are a bit more relaxed, because when you want to automate certain things, you want to do things much faster. And I think people are starting to abuse the system a little bit. They are submitting claims that I feel that may not be real transactions, right? And because Lemonade wants to automate a lot of things, so there are certain things where they're actually losing a lot of money right now, because people are claiming a lot of making a lot of claims. Other than that, I'm not too sure about the model. I did previously look at it, and I've used some financial industry leading ratios to compare them. They seem to be not able to hit profitability even after growing for so long. And the scarier thing is that while they have not mastered certain portion of their insurance business, they are moving on to further things. For example, they're doing home insurance, they're doing pet insurance. So I do feel maybe they're stretching themselves a lot further. But I would say that I don't have very specialized knowledge in insurance companies, and I don't want to claim that. I'm much better on consumer, on e-commerce, on payments, on software companies, right? So Anthony, maybe that's the thing you have to look at. You have to look at their losses to see whether they are going to minimize the losses, or the losses is going to continue on. So while I can say that revenue growth is fantastic, but you have to look at other factors as well. Yep.
Okay, great. Thank you for that. Next up, we have a question from John. What are your thoughts on Alibaba?
Yeah, I think that's a great question. So I did write up something on Alibaba, which I do want to share with all of you. Okay, so I just want to ask all of you one question, right? Assuming you are imagine you are the great dictator of China, right? Or maybe president of China, yeah, Xi Jinping. And today, Tencent and Alibaba has been making a lot of money, right? Has been growing. But you see, when Tencent and Alibaba is growing, and then who are the largest shareholders of Tencent and Alibaba? They are Americans, all right, which is all of you and maybe Singaporeans, right? So do you think it's very weird that if Alibaba and Tencent makes a lot of money, and instead who really gains the most benefit? It's not the Chinese, it's actually American. So if you're Xi Jinping, right, how would you feel about that? Just type in the chat box. How would you feel about that? Would you feel happy? Would you feel sad? Or would you feel angry? All right, let me know about it. Feel weird, right? Like, okay, like Alibaba, my greatest company, but they're not listed in China. So the shareholders are all Americans. So I'm actually making the Americans rich. I'm not making my own people wealthy. So I think there's a flaw over there. And I think Xi Jinping actually recognizes that. So Xi Jinping right now is going to create a stock exchange in Beijing. And I think sooner or later, they will ask the big boys, the big giants, to come back to the home ground to get listed. So in terms of China, right, I can tell you it's run as there's capitalism. Yes, it's true, but it's also run like a communist country. So whenever you think about, capitalism is about profit maximizing, right? But every time you make a lot of money, the government clamps down hard on you and say, hey, you're going to donate X amount of money to the common prosperity of China. You can look at Alibaba recently. I think in total they committed $15 billion to support the development of the country. Then you may want to ask yourself that if you have a government that can control how much profits you're going to extract from your consumer, or even force you to actually donate some form of money, would you want to invest in a company like that? I think those are some concerns. And I think if you look at ByteDance, which is the guy who created TikTok, you look at JD.com, TingTong, you look at Pinduoduo, you look at all these CEOs, they're all stepping down, because when things are not run in a profit maximizing manner, it actually dissuades people from giving their best in the company. And if everything is communism, then no one's going to work hard. No, everyone's just going to rip off the benefit of each other, right? So the way I look at it, yes, Baba is great. Charlie Munger bought into it. There are so many other reputable investors who have bought into it. But I'm not into Baba. I'm not into all these Chinese companies, because in a way, I feel that there's increased regulatory risk coming from how Xi Jinping is behaving. And is your money really your money when the government can take it away from you, right? And your profits are not your profits when government have to detect how much profits you can make off your consumers. So there's a lot of clamp down on Ant Group. As you know, the Ant Group IPO got delayed. I'm not sure whether they're going to IPO once again. Some of the business have to be restructured for Tencent as well. Some of the media businesses have asked by the government to divest as well. So Alibaba and Tencent, all the hardworking executives have built a competitive moat for themselves. But right now, the government is just coming in and say, hey, you can't do this, you can't do that. You got to share your data with your third-party players, and literally are giving your competitive advantage away to other players. So would you want to invest in a company like that? I'll leave the answer to you. So that's really my take on the Chinese companies currently. But just fundamentally, it's wrong that if Tencent and Alibaba has done really well, but it's enriching the Americans, it's not, like the Chinese cannot invest in Tencent and Alibaba right now unless they have access to the Hong Kong stock market, right? So you can see a lot of Chinese are being they're not given the opportunity to invest in their own local companies. So that's weird. I can tell you eventually they'll be delisted from US and go back to China. That's just my take about it.
Yeah. Are there any resources that you can share that you use to research companies?
Yeah, I do think I can share a little bit on that. Okay, I share with you something, all of you something cool, but I just want to find out how many of you actually know about this company called Hypebeast. If you know about this company called Hypebeast, type it in the chat box for me. For example, for gaming companies, right? So there's this company called Gravity, right? It's a company that creates Ragnarok online gamings. So you can see that the share price have done really, really well from March 2020 all the way to somewhere December, up about 500%. They kind of came down quite a little bit, right? So all these companies, when they make money, they make it through apps, right? So what I do is that I have this website called App Annie. I think it's really useful. You can use this and you create an account and you can see the app ranking of the games. So let's say if the games start to move up very quickly, right, in terms of ranking. Let's say this quarter, you look at the ranking, maybe the rank is 13. And this quarter, you look at the game ranking, it has suddenly gone up to like position number 2. Without even thinking, without even doing some crazy math in your head, right? This quarter, will the revenue be higher or lower than the previous quarter? Just type in the chat box, all right? So if the ranking moves up, right, from 13th to 2nd position, will the revenue be higher or lower? Will be higher, right? So I do incorporate a lot of alternative data for myself so that I can actually gauge whether the business is doing well or not doing well. Other than that, I always look at things like maybe investor relations. I think is a great way. You can look at the investor presentation website. It tells you a lot of things. Another thing that I look at is Seeking Alpha. So, but I have to bear in mind that Seeking Alpha has a lot of opinions that's given by different investors. So you want to read, you want to learn, you want to see how they think, so that you can also formulate your own ideas. Because the end of the day, it's not about reading all the articles, trusting everyone, but reading and asking yourself whether what makes sense. But I would say Seeking Alpha is really a great resource for me. Another one is called Weibo. So Weibo, you can have access very quickly to the financials of the companies, so that you don't have to, open up Excel file, do the numbers. I mean, today we really have a lot of very advanced free softwares that we can use online. So Weibo is one of it. Why do I like Seeking Alpha? Because they have earnings transcripts, so I can actually understand how the management is thinking. So for myself, I also write articles on Seeking Alpha. I do want to contribute. So this is my profile that all of you can follow, right? So SoFi, PAR, I write about Facebook, Tencent as well. So a lot of my views, they're all expressed online. And I think when I do that, it actually puts me out there to meet other investors as well. And that's how I value add to the people in my community. Yeah, and also to all of you. So in summary, I use App Annie, I use Seeking Alpha, I use Weibo. And I think if I have more, because now, once I have more softwares, more websites that I can share with you, I will actually type it in the Facebook group so that all of you can take note of it and also can start using it as well.
Are there any other metrics or factors that you would look at to identify promising high growth companies, other than the revenue growth and the CEO and the net debt to equity ratio? Like what would you consider the most important?
Yeah. So I do think that the business balance sheet has to be really, really strong, because without a strong balance sheet, it's very hard for you to continue on a business. When an external shock comes in and you have tremendous debt, that's a perfect storm for you. Your business will go bankrupt. So if you look at revenue growth, yes, I think that's good, right? 30% or more. So in terms of other ratios that we look at, I think we want to see increasing profitability, right? If the business is able to increase its profitability over time, it shows that it has pricing power. If today Apple increased the price on their products by 10%, 5%, I still do think that consumers will buy. By the way, how many of you think that Apple products are kind of expensive? Just type it in a chat box. I have an AirPod Pro. I bought it because there was a discount on the e-commerce platform. Otherwise, I felt the price was a bit high. Okay. I want to digress. I'll come back to this ratio. So the other thing that I look at is whether the business is capable of expanding geographically, right? If they're today in the United States, Square, Cash App, right? I think some of you are very familiar with Cash App. The Cash App, I think is doing really well. So now I think they entered France, they entered Canada as well. So you want to see that the business is able to expand. You want to be able to see that the business is able to create new products as well, right? Cash App, I believe, it's a way for you to transfer money like Venmo. But now I think they're going to roll out insurance. They're going to roll out trading cryptocurrencies as well. So you can see as they are releasing more products, what are they doing? They're creating a more sticky product, right? And you'll be entrenched with their product. And when they provide you more services, they can increase the revenue they earn from you, right? Maybe last time they only earn like $2 per user, but now they added more services, more users use more of their services, they earn like $65, right? So I think there's only a limit to how much you can grow your revenue if you're selling one product, right? But you're starting to release more product, useful products, right? I think Apple is the same thing. They are doing Macintosh last time, then they do AirPods, then now they are doing so many different things. A business must be able to evolve, must be able to grow. And I would say that, yes, as much as possible, I would like to see, to share with all of you the financial ratios, but I don't think that's the highest value add I can do for all of you tonight. But what I want to share with you is that what are some signs of a business that's transforming, that's growing, right? A leader that is transformative. I think that's really crucial. At the end of the day, back to the same story, you're investing in a management team. You take out a management team, you just have a corporate structure, you just have a bank, there's nothing in the company. It's all about the people. And lastly, I do want to share with all of you one of the metrics that I track quite closely today. I mean, sometimes I look at press releases, right? If a small company is able to attract a big talent to join their company, it means something. I look at the flow of talents. Who are the people they're attracting and where were they from? So if today I'm a small fintech player, but I'm attracting a lot of people from Visa, from Master, it kind of shows that this business is heading somewhere, right? There are people who are responsible for managing billions dollar of business, but now they are so excited and they are joining Square to transform how money is being transferred. I think that is incredible. And also, I just want to share with all of you. I think I got a private message. So, those of you who are interested to the wait list, just go to www.growthinvestormastery.com. I think you will see a wait list and you put a name there. And once it's available, we will actually send you an email and you can actually consider, right? Okay. I think Tesla is, okay, I just share with all of you a few things, but this will take a long time. So just want to let all of you know, because Tesla, I think there's a lot of things to talk about, trying to arrange the thoughts in my head, all right? Today, if you look at a car manufacturer, the reason why they are not having very high margin, because a lot of it is very labor intensive. In a car, right? Just imagine if I tell you all of this, you might be shocked. There's over 9,000 parts in a car. It's crazy, right? And increasingly, it's becoming more electronic based as well. So Tesla, I think what they have achieved is amazing, because they currently have a higher operating profit margin, because they are trying to reduce the number of workflows in manufacturing a car, right? In terms of a car body, right, they are doing a single mold with different a single mold instead of having various molds and being welded together. So they have actually saved them a lot of costs, and a lot of things are all operated by robots. I think they are very efficient at that. So today, Tesla is already profitable on the machine on the car side. So just think about it, right? Apple, right? Why would they want to come out with cheaper versions of iPhone? Wouldn't it affect their branding? Well, they are not just aiming for the iPhone. iPhone itself is like an installed base, and subsequently they sell you the services, which is the iCloud, which is Apple Arcade or Apple Music or whatever it is, right? It's just like simply like Nestle, right? Espresso machine. You buy a machine, buy the capsules, and you cannot buy other capsules. You only can buy their capsules. So where Tesla and Apple and I think Nestle is focusing on is a recurring income. And today they are slowly releasing a lot of software updates to their Tesla. So just imagine if they price it this way, right? If you want to get regular updates from Tesla, you have to pay $10 per month. Maybe that's just a simple $10 per month. You may not think anything about it. And subsequently, they say, you want to have the full extension, the capabilities, enjoy the full capabilities of Tesla, you must pay another like maybe $20, $30, right? So it's all these micro small payments that people don't think about, but it adds up, right? And you think about it. So I've already earned my money from Tesla, and I've made returns from selling the Tesla cars. And back end, I'm going to build a very sticky sticky revenue streams, and I can actually increase it, right? If I increase my price by 2%, 5%, I think it's quite doable. And I think the second thing, which is really quite transformative in my point of view, is that I really do believe that in the world, we don't need too many cars. You see, even at any single point of time, there are so many cars that's being parked in the parking lots, right? And just imagine Tesla creating this, right? Just imagine all of you bought a Tesla, right? In a day, you send your kids to work. No, you send your kids to school, not to work, right? And you go to work, and your car is being parked in the parking lot. What if Tesla could install a software on your car, right? And your car would be just going around the roads in California or whatever, right? In Texas, picking up random strangers and charging them, let's say, a Uber fee, right? And let's say the cab fare was like $15, but Tesla will take like maybe 50% of it, and 50% of it will goes to you because you're the owner of the car. And while you're working in the office, the car is out there in the road working for you. And every month you're collecting money from there, right? So ineffectively, right, Tesla is going to be cheaper because while you pay for the car, but the car it becomes not a liability, but it becomes an asset that earns cash flow for you to offset or whatever your software upgrades whatever your software upgrades are. And I think the second point is that look at the miles that they have collected, right? The amount of data. I think that's incredible. Like, people would always want safety features, and I think there are a lot of news. While I think Tesla have some news where they say, people got accident, people died, but there were also a lot of news that Tesla has saved the car owner. So wouldn't you want to have a safer car? So I think with a lot of things that's coming out of Tesla, I think people are valuing it as a car maker, but if you start to value it as a software operator, where I think a lot of people, we actually spend a lot of time in our cars, and that's going to be I think that's going to change the financial profile of the business, because a software margin is about 80% gross margins. Manufacturing car is about 15% gross margins. If you kind of blend it together, could Tesla be a 40% gross margin business? And if you are earning, could Tesla earn a 40% profit margin business? If it could be, then I think the valuation would change drastically. And if you just do a very base comparison, the number of Tesla cars that's being produced in a single quarter right now, compare that with General Motors, Ford, and all these bigger players, I think Tesla, there's still a lot of room to grow. So if you look at Tesla and you say that the market cap is really huge today, but I would just counter argue with this thing, right? Huge compared to what, right? If you talk about huge compared to the market caps of the other car makers, then I think a lot of investors are seeing it wrongly. But you look at huge in comparison to the software that they could charge, the total addressable market that it could serve, I think things could look very, very differently. So I do know that a lot of my thoughts are a bit jumbled up, and I don't want to make excuse for it, but I it's a bit early, but that's how I could really frame up how I look at Tesla a bit for all of you. Yeah.
Thank you. No, I think that's a great way of like looking at your insights and your mindset when you're considering a company. Like you consider, the total addressable market, and a different way of looking at a company, just other than what it's currently doing now, but what it can do in the future, and so on. Yeah. So thank you. Do you have time for one more question from Rajiv?
Yeah, sure.
Excellent. So Rajiv, with the big questions, what are some companies that you are looking at right now?
This is what I call.
I figured we have an expert here in Kelvin and limited time here. This is such a great forum. By the way, Kelvin, this has been fantastic. So really appreciate you spending the time here and spending some time. I mean, this has been amazing. So yeah, I mean, I'm asking questions because, hey, I want to learn more. I want to pick your mind a little bit more. So I want to hear everything you can give us.
I can share with all of you. I mean, I can see all of you. So thanks so much for turning on your webcam as well. Raji is the best investor here because he's asking the right question to the management. All right. I can really share the names, but I don't want you to buy it the next day, because it's so important to understand where the business is heading, and it's never my intention to just. I also don't want to be seen as pumping up a stock or whatever, but I think the business that I'm buying anyways is big. It can't be pumped up by me alone. So I want to steer clear of those issues. But let's just talk about the companies, right? So one of the companies that actually I'm very, very confident about, because I'm also based in Southeast Asia, Singapore. I also don't like to use this marketing term like, this will be the next Amazon or what, but I truly believe in it. It's a phenomenal business. I think a lot of Americans, they are not understanding C very well, but I'm very thankful and very blessed to be this part of Asia. C is an e-commerce player that's dominant, that's ranked number 1 in Philippines, Vietnam, Malaysia, Singapore, Taiwan, and Brazil. They are increasingly going to Latin America, Indonesia as well, which is a very big market, and also Poland. And they've been executing really, really well. And what I like about a business is it is very easy to understand. And it is very easy for me to tell whether the business is doing well or not. Like just by using Google Trends, just by checking the ad rankings, they're always consistently number 1. And if you look at the business, the gaming business, that a lot of people think, okay, your business is running at 1.2 billion run rate, but yet you're still growing so quickly, right? If you look at e-commerce as well, I think the revenue has grown phenomenally well. So I do want to encourage maybe all of you to actually look at C a little bit deeper, understand the business model. I think there are a lot of YouTube videos as well and a lot of articles on Taking Alpha. I think that would be a very good resource for you to start off with. The other company that I can talk about is SoFi. SoFi is actually based in United States. It's actually a fintech platform. I think the management is phenomenal. It's incredible. His name is called Anthony. If you watch his videos, you will actually know more about why am I so passionate about SoFi. But I have another company that it's a bit a different style of investing, but I also do believe that there could be a lot of returns coming from this business, right? So this is not like my typical high growth 30% business, but this is a business that was previously mismanaged, but right now a new management have came in and actually created a lot of new changes. And I would say that if this business right now is a turnaround company and eventually becomes a growth company, there could be a lot of what we call the price multiple re-rating, and the share price could actually rise rapidly as well. So I wrote an article about it. All of you can check it out. Insight Distilling. It's in Portland. So if you have some friends in Portland, do let me know, because I'm actually very, very interested to know about their views on Insight Distilling product, right? So in summary, SoFi, C, and also Insight Distilling. I think that's enough, because if there's too many names, it's just really hard to look at all those names. But I do think it's a great question. So thank you so much, and I'm very thankful to be here. I'll pass back to Sam.
Thank you for joining us today. If you'd like to stay up to date with us in the future, please subscribe to our YouTube channel, visit our website, and join our Facebook group.